Welcome to the Seattle Investors Club podcast with Julie Clark and Joe Bauer, where we share the nuts and bolts of real estate investing from our 20-plus years in the industry. Sit back, relax, listen, and immediately take action. Are you ready? Here we go.
Welcome to the Nuts and Bolts of Real Estate Investing podcast. My name is Joe Bauer, and I'm here with my co-host, Julie Clark. Julie, how you doing today?
I am doing good, Joe. Still on break with the kids here, so had to make sure I gave everybody something to do so they wouldn't bust in my office here while we were on the podcast, because they pretty much don't care if I'm on the phone or on a podcast. They'll jump in and tell me they want some avocado toast or something like that. So hey, did my best. It could happen. That's what makes it fun, right? This is what makes it fun.
Could I have some avocado toast?
I'm happy to get you some avocado toast, Joe. Yeah, that's kind of Addison actually throws a fried egg on top of her avocado toast. I don't know about you guys, but she's one of those fried egg people. So
I dig it.
Sounds pretty good.
There you go. So where are you at, Joe? Because we are deciding where to go for like New Year's Day to hit some mountain somewhere. Thinking about White Pass or maybe Mount Hood Meadows. What do you think?
Yeah, go for it. We're right now in Enumclaw, so we're close to Crystal Mountain, but it has just been so packed here. I was telling you that on the text the other day. It's like we went up on a powder day last week and did 2 runs. It took so long waiting in lines that it wasn't worth it. So we're looking forward to getting away. I think that going someplace like what you're saying, out of the general, Seattle shoot up to the mountains area would be a fantastic idea.
Was that a weekday that you were there or weekend at
Weekday.
Crystal? Ooh. Yeah, we were at Baker this weekend and it was the longest lines yet. Still not that bad, but so we're trying to figure out where to go. But that should be fun. So where are you guys all today? Albert, where are you?
I'm in Irvine, California. It's kind of where I stay when I'm not in Washington. So
nice. And how about you, Justin? Where are you at today?
I'm in South Seattle. I'm actually in my Airbnb rental unit. I'm in between stays here. So when it's open, I come down here and use it as my pseudo office.
Oh, cool. That's a nice idea. Well, this is what we got going today, guys. I'm going to look at my notes here because we don't do things perfectly here. But today we got Justin and Albert with us. Justin is an investor based out of Washington who has figured out the equation of using his day job to help him build his ever-growing real estate empire. And today we're going to give you guys, all our listeners in podcast land, some insight on how Justin has been able to accomplish building a portfolio of 28 properties with 62 doors, and how you guys might be able to accomplish the same using your W-2. Right, this is something we haven't done a deep dive on how to use your W-2 to take advantage and build a rental portfolio. So we like to go down rabbit holes. That's what we're going to do today on this topic. And to assist, because I don't know everything, we have my man, Albert Bowie. Avenue One Capital Inc. is Albert's company. He's a mortgage broker. Many of you know him, super talented. If you've been on any of our local real estate investing community threads, you have taken notice most likely of how eloquent Albert is and how he explains things. And if you look back, Joe, maybe you can look back at the podcast we've done with Albert in the past. This guy, Albert, our friend, has some major nuggets that he drops. He talks differently. He knows tricks and trades and tips of how to get you through the financing process, especially if you're an investor. So we are lucky to have Albert here help us guide the conversation with Justin today. So let's kick it off. Joseph, ask him the question number 1 we like to start with.
Yeah, absolutely. Justin, so question number 1 is a very hard one to answer, so get ready.
All right.
No, man, it's all about how you grew up, where you grew up, and how that led you to where you are today. We just like to get into it and get to know you a little better.
Yeah, so it was funny you were talking about skiing, going, and you're in Enumclaw. So I actually grew up in Enumclaw, spent most of my childhood there. Grew up on a small farm. We had cows and everything while we were growing up. But really, what got me into the whole real estate game, I go even further back than that. Is like when I was growing up, I used to play with my grandma all the time, Monopoly. And over time, I just, really enjoyed playing that with her. The four greenhouses, convert that into the red, and we'd play that as I was growing up. And then, fast forward now into about 4 or 5 years ago, I had bought properties as I was kind of developing into my career and moving to different states. But I really didn't get into the investing game until about 2016. And then I was in the point where there's kind of multiple converging factors. Where the first one is I was at Amazon, and I had all these RSUs coming my way. At the same time, my dad was diagnosed with cancer, and so I had kind of a lot of money coming my way, and then a lot of like personal turmoil type stuff. And I'm like, my dad had basically worked. He had his own business, so he worked like 7 days a week. I'm like, man, I don't want to. I'm on that same track, so I've got to figure out a different way. And so I started off. I didn't know at the time in 2016 with a house hack, and then after that, what really was like the kind of the match that really spurred this thing is actually when my dad had passed away in February 2017, and then I just was like, okay, I got to find a way out as fast as possible so that I can spend more time, doing things I like versus working. And so ever since then, I just been slow. I shouldn't say slowly, but it seems like every other month or so, I've been acquiring properties, trying to build it up. Purely at the beginning, 100% focused on cash flowing properties. Towards the end here, more recently, I've kind of changed that philosophy, but we'll get more into that in depth, I'm sure, with the next couple questions.
Excellent. So started off with an accidental house hack. It's a lot of people just kind of accidentally fall into it like that. So, but for those that don't know what you mentioned the word RSUs, explain to the crowd what that is a little bit, so we are all on the same page here as we move forward.
Right. So RSU stands for restricted stock units. And I specifically work at Amazon. And there's a total comp structure. There's a base salary component, and then there's these restricted stock units. And so when you get hired, you get X amount that vest over a certain amount of years. And what vesting means, it's when you actually get the shares. So, for simplicity, if I get 10 shares and it's vesting 25, or I should say, 25% per year, I would get 25% of those 10% shares. This specifically Amazon, but if you look at a lot of the tech companies out there, the Facebooks and the Googles, and Apple, they all have some sort of this base salary with some RSUs. The whole purpose of that is to get you to be motivated to put in more into work, such that if you increase the output, theoretically that translates to more improvement in stock price, which then ends up rewarding you. I've been fairly lucky. Like, obviously, we're all from the Seattle area. We know that Amazon's done very well, and recently extremely well in terms of stock price. So been using that to help me grow my real estate portfolio.
And what does that mean? Does that mean that you cash them in to use that for some of your capital needed on your purchases, for example? Is that what that means?
Yes, I've used it kind of multiple different ways. So the very first way, I was just kind of getting into the game. I got my first big chunk, and I was like, hey, I've got to find a way to, get cash flow. So I ended up selling my first chunk, putting all that money in as a down payment on an 11-unit property over in Yakima. And so that's like the first way I used it. Then I've used it in other ways where I have RSUs that have already been vested, and I show that in terms of cash. So like, and Albert can probably explain more on this, but as the lenders are looking at you, they want to understand your cash flow situation, your debt to income. So the more of these RSUs or stocks that I have vested that are sitting on my personal balance sheet, I look better from a lender perspective. And then the third way that I've used this twice, I think now, is where I take those shares and I don't actually sell them. I can take a loan against them. So it's almost like a margin account if you're a stock trader. So the shares are still sitting at the bank, but they give me a portion of that amount for me to then go and borrow. The reason why I did that is, I think, the stock market's been healthy. Amazon's been doing well. My thoughts are, instead of selling them, let's just kind of ride it. Let the stock market go up. I'll pay the interest on that money that I borrow, and I'll make money on that money at the same time. Ideally, the RSUs or the stock value goes up. So in hindsight, I got lucky. Everything went perfect to plan. For the listeners, in the future, that may not be the right case. You could get double negative where the stock price goes down and the property that you used that you pulled the money out of the stock could also go down as well. So it's definitely something that you have to go into understanding both the upside and the downside and make sure that you're comfortable with that.
Good stuff. Anything you want to add on that, Albert?
Well, he did mention the assets. So yeah, once they're vested, you can use them for cash reserves. Usually on rentals, we need generally 6 months of payment reserves. So it's nice to have that option when you have restricted stock units to show more assets. Otherwise, you got to keep cash sitting around or other money, and you got to tie up stuff, right, Justin?
Exactly. And so as I've kind of moved, growth is a function of cash that you have. And so it ebbs and flows. And so I've got to use different types of cash. So first it was just cash only, then it was these RSUs. Now I'm getting into, if you're familiar with independent banking concept, but just basically overfunding whole life insurance policies. So that's where I keep my cash nowadays. But
I use that as well.
Yes.
So that's where I keep my reserves.
Mm-hmm.
Well, that's a little rabbit hole we're going to have to go down for a minute. So let's circle back to that in a second. Let's talk about first who the key players on your team are, Justin. Who are the key players that you surround yourself with? That, I mean, you still have a full-time day job at Amazon, is that correct?
Exactly. Yep.
What do you do at Amazon? What's your discipline over there?
So when I originally came to Amazon, when I graduated from Berkeley, I came here, did a career switch. I got into finance. And I bring that up to say that I was in a rotational program. So I worked in advertising, but then my second role that I got into was related to, if most people here are familiar with Amazon Fresh, grocery delivery. Within that group, I had multiple finance roles. The longest portion of it, I was in the capital management. So understanding where all the buildings were, how much they cost, running the net present value equations for them. So that's where I really started understanding how does this whole finance game work with, putting out capital and making sure that you're going to get more of that capital back than what you put into, which really helped me from I'm doing, these were multi-million-dollar deals. And then I'm looking at these properties that are, only thousands of dollars. I'm like, well, I do this all day. Naturally, I can transition in it to over here. I've had a couple different roles, but most recently, I'm trying to marry my passions outside of work with what I do at work. So recently in March, which is actually the first week of COVID, I took a new role at Amazon. So I specifically focus on finding warehousing space across the U.S. for a couple of the different business units.
Oh, cool. That sounds fun. I almost took a job like that with Starbucks eons ago. Good stuff. So let's get back to who are the key players on your team these days that make your life possible. I know that Carl is one of those players on your team.
Yeah.
Carl,
So I actually
you know what I'm saying when I say Carl?
Yeah. Carl, there's two Carls. I was thinking Carl off of Facebook. I think you're talking about Carl, my dog.
Yeah.
Is that what you're talking about?
Yes.
Yeah. I always say he's my co-pilot. I take him with me whenever I'm going to properties or doing anything local real estate. I'll take him around with me. Keeps me motivated, keeps me happy there. In terms of team, it's just me, but I have a lot of different people that I work with. So I guess I'll kind of section it by state. So I do real estate in Washington, Michigan, and Wisconsin. So Washington area, the people on the team that I have multiple interactions with are Enrique Jevons, which I'm sure all you guys are familiar with. He was like one of the first guys that helped me out because I bought that 11 unit in Yakima. Everybody knows if you're in Yakima, you got to connect with Enrique.
Who's property manager, we'll say. If you guys
Yeah.
don't know Enrique, he's a property manager as well as an investor and owns many, many units, probably over 100 units himself.
Exactly. So yeah, he definitely helped me on all the property management stuff, but he's helped me as from more of a education. Yeah, as I was getting in, he was kind of telling me how to use money, how to work it around, how to continue to grow, what to spend money on, what not to spend money on. So that was a big help. And then other thing locally is local banks here that I've been working with on. I used to have a lot of loans with U.S. Bank, and so a lot of interactions with the wealth management group and the commercial mortgage group. Those two groups have helped me kind of get into, probably property number 2 to 20. There's a lot of interactions with U.S. Bank. And then some of the properties I own in Washington are tiny homes. So I work a lot with Todd McKellips. If anybody's in the tiny home niche in this area, he's the number one guy in tiny homes, and he owns Seattle tiny homes, and so he manages 3 of my tiny home Airbnbs, and he's actually building me a 4th Airbnb right now, tiny home.
We know Todd. Yeah, we need to have him on. That's for sure.
Mm-hmm. So those are in terms of Washington, those are the main people. Outside of that, there's a lot of other people, that I connect with that I don't necessarily do business with, but I learn a ton from through networking, through your group here, Seattle Investors Club, and then Tarl's group. I do a lot of those meetups. I can't wait till we go back to real in-person meetups.
Right.
What are the other ones I go to?
You buy out of state as well, is that right?
Yeah, exactly.
How does that work for you out of state?
It's worked really well. So the evolution is like, I was saying that growth is a function of cash. So I bought that first property. I think I paid $365, and then I had like 50-ish something thousand or something to get into it. And then I was like, well, how do I get more properties with less money? And at that same point in time, I was like, I couldn't find anything within Washington that would really cash flow. And, I was like, oh, let me check out Milwaukee area. And the reason for that was like, I used to work at Cargill, and I would go on these golf trips with these guys every year in Madison area. And so I was like, I heard on Bigger Pockets some guy talking about Milwaukee, and I'm like, I got to go check this out. And so I think my first trip out there was August of 2016. And I was just, oh my God, this is like Seattle with one less zero in the end. So I started really aggressively buying there. So most of my properties are in Milwaukee. But yeah, everything has been great. Like the pricing of everything is so much cheaper. So I average per door $30,000 to $50,000 per door.
Oh, wow.
Which is pretty crazy. And then the rents, if it's a 1-bedroom, it's, about $500. If it's a 3-bedroom, it's around $750. So you can do, the 2% ratio is, I can do that all day long out there, all off of MLS as well.
Wow. Go ahead, Albert. Let's go with number 5 on your list there. We're kicking off. We're multitasking over here.
Nice. So, those are mine, huh? I didn't know. I thought those were just the most important ones. I figured
you are the most important one here. So
no, there's the list I have has bold red, like they're extremely, important. So I said, Justin, did you stumble at all when you were getting started over there in Milwaukee, or any mistakes you made that you could let the audience know? And what is the biggest lessons you've learned out of state?
Biggest lessons learned, and did I stumble? Definitely there's things that I've learned and stumbled with. The good part about the Midwest and in Milwaukee is that I know going into this, like it's fairly small small increments of investing. So like I'm willing to take a lot of little bets in order to win. So I've kind of decreased my risk level by buying these cheaper properties. Generally speaking, it's only $15,000 to $20,000 for me to get into these properties. But in terms of things that I learned over time is like, if I was going to start into a new city today, I would fly into that market, connect with people, and look at the different areas. Like what I do nowadays is every time I'm in town, I go to different areas I haven't seen. I look at the Truly a Crime map, and I try to marry up what does dark blue look like on the Truly Crime map versus where in reality, what does light blue look like, and try to really understand where the market's at. Obviously, you can buy cheap properties anywhere, but cheap properties in bad areas are not always the greatest. You're going to have high turnover, going to have a lot more damage. And I think one of the stumbling blocks I got into is like, as I'm buying some of these properties, they're all 100 years old and they have a lot of deferred maintenance. So it's like being more diligent up front on, okay, what do you got to repair right away? What do you can repair in the future? And then proactively working with your property managers to manage those fixes in the future. So for me, I didn't do that. I just was buying. And then, as soon as the first winter hits, everyone jacks up the furnaces. And I was just like, furnaces were breaking left and right. And then I was like, okay, now I'm like, instead of getting cash flow, I'm having to, owner contributions to pay for all this stuff. So that was probably my looking back at it is like, I was putting all my chips in on acquisition, and I wasn't like putting enough reserves. And the good news is like I was able to, I always knew I had RSUs every 6 months kind of dumping into my account. Like that was kind of my backup option. But in hindsight, I probably should have had more reserves than I did.
What do you recommend that, on these out of state, cash flow properties, I'll say, that are the less expensive ones like that, or any property actually? What do you think about reserves? What's your recommendation now that you're, what do we say, 62 doors in?
Right. Yeah. I'd probably say, the standard answer you always hear is like 3 to 6 months. Mentally, like I'm always on the aggressive side. Like, so I would say bare minimum just at a macro level is like 25K. Because I know I got rents coming in. I know I got mortgages coming out. I got cash flow there. If I have 25K, that's 1 to 2 roofs. That's a couple furnaces.
You mean for your 25K for your portfolio?
Exactly. Yeah. That's on the very aggressive side.
That is pretty aggressive.
50K would be where I would have no problem sleeping at night with 50K. That gives you enough kind of wiggle room. 62 properties, 28 properties sounds like a lot. But when you're dealing with these lower property values, like that's not a whole lot of like mortgages. Like you would think it'd be massive, but it's not as high as you think.
Well, let's jump into it, Albert, in regards to, let's go into the financing stuff. That's what we really want to help people understand today. And I want to kind of turn it over to Albert and you to have a conversation. I guess, I don't know, the easiest way to do that might just be like, to take it through how you financed your first few properties. And later on, we can talk about maybe how you've used seller financing to grab a couple properties. But today we want to focus more on, the RSUs. And for those, there's so many people that are listening to this that are probably on the fence of wanting to be, how do we jump into investing? And they do have RSUs and stuff like that at their disposal. They're not quite sure how to use them. So maybe Albert, we'll start with you on how you feel as a lender that people can start and start their investing career using, cash they have or their RSUs. And then we'll go through a couple examples on Justin's purchases that applied specific info.
Sure. Yeah. With RSUs, kind of like what Justin mentioned, you can borrow against them, kind of like a margin account. We don't count the payment on the borrowed money, so that's a key for many people that are afraid to borrow the money, because we assume that since it's your asset, you're borrowing against your own asset. It's like you're borrowing within your own world. So we don't count that payment against you, unless it shows up on the credit report. Now, so that depends. But that you can use it in that method. You can just sell the stocks, kind of like what Justin mentioned. You can use that for the down payment or the closing cost. If they're vested, we can use them as cash reserves. So that's money that doesn't really leave your pocket. It's just you document that you have money there liquid that you could sell the stocks to use as reserves for your loan file. That's it, just to close. So it's important to mention that money doesn't actually get used. I think
the point is that we need to have cash to put down to purchase the property.
Right.
And then we need to, the two things that need to be covered, and unless there's more, one is your equity, the cash required to close. That could be just depends on the deal. It could be anything. Number two would be that the lenders are we talking about on the purchase of the property or the eventual stabilized refinance, that these reserves, that's the part two, cash to close, then reserves to satisfy the lender, right? Or is there anything beyond that we need? And then I guess, as Justin mentioned, maybe beyond just lender reserves, as an investor, you want reserves in order to take care of problems that arise on the properties. And as Justin's mentioning, that he feels comfortable that he knows he's getting these RSUs every month that kind of for him count towards those reserves. Is that fair as a three-pronged review of what to use the RSUs for?
Yeah, first part, there's the money. And then, of course, it's how you deploy it. You can do owner occupant, house hack. You can buy it like his, which are probably investment properties because he's out of state. So there's the occupancy part of it, where how are you going to buy it? Like, is it a second home? You're going to Airbnb it. But ultimately, we're on the topic of using RSUs. So those are the multiple ways you can use them to acquire the properties. I'm sure Justin will go into how he did a few examples maybe. And we'll see if you use conventional, right, Justin? Or if you use commercial, maybe US Bank, who knows?
Yeah, I've kind of done a little bit of everything. Just given to continue to grow, you have to get a little bit more creative and figure out what to do with them. But the other thing on RSUs that I'll bring up is like, you have to think about what how you want to use them, where you think they're going to go. Do you want to count that as income, or do you want to like hold that as reserves? Or because I know that everybody has different risk tolerances. Some people have them and never have sold any of them, which they've done very well in. And some of them choose to cash them in right away and put them into different things. I mentioned earlier I was in finance, and like lesson number one is diversification. So at the beginning I was like, Seattle and my job and my retirement are all linked to one thing, Amazon, right? So I was like, well, okay, I need to like diversify here. So I was selling them at the beginning. But then as now I've purchased more properties and I have more equity built up outside of Amazon, I'm like, well, maybe I'll hold on to these. So it's like, you got to think about what you want to do with them, and just whatever that plan is, just hold and execute on that plan. I mean, hindsight's 2020. Like I wish I would have sold any and borrowed against all of them. But hindsight, you would did
you just not know in the beginning? Did you just not realize that you could borrow against them, or what's the story?
Yeah, I didn't know, and I was trying to continue to grow, and then I was talking to, you get into like every bank has like a wealth management group, and so you start talking to them. I'm like, well, I need money to continue to buy these properties. How am I going to do that? What are the options I got? And I was like, well, I don't really want to sell them. And they're like, well, we can do like an asset-backed loan. I'm like, oh, tell me more. Tell me more about this asset-backed loan. And then I was like, God, this sounds great. It can be a double up. It can be an up and a down, and it can be a double down. Like I was mentioning before, I've been lucky. It's been a double up. Like my stock goes up, and the money that I borrowed, I bought properties that create cash flow and have gone up. So, life has been, I've been pretty fortunate in that aspect of it.
Albert, have you run into anybody using RSUs that has ended up having any problems later as a result?
Not that I know of. No problem. But I did want to mention RSUs could be used as income too. I don't know if I mentioned that, did I? So 3 years generally. There are some lenders that will do 2, but most cases you need to. But that means you need to be on the job for 3. So for him, he's been there forever, so that's fine. But not everybody is in that position because they just switched from Google to Redfin or something,
Well,
and now
let's back
Redfin's
that
good.
up because I think you jumped into that quick, and you're making a great point. So, Albert,
Yeah.
what you're talking about is people need income to qualify for loans, and that. Now let's back it up, and you're talking about that they can use their RSUs to qualify for income, or tell us what you meant there exactly.
Well, it's kind of like a Swiss Army knife of assets. They could be used as reserves. It could be used as down payment. It could be used as income. It could be used as almost everything. You just can't provide credit. Of course, you got to have your own credit report, of course, and pay things on time. But for most of the loan scenario, the file, it could actually cover all the other areas. I mean, especially if you have enough. Some people have a ton of RSUs, especially with that Uber IPO. I had a guy that had like 7 figures, but I bet you that guy was probably day 1 employee number 2 or something. Who knows?
Mm-hmm.
But so how does it work? Count them as income? I mean, do they have to be sold and taken, or
no?
Is there any? What's the rules?
I get 3 years end of year pay stubs. I just document what they got year to date. We just average that over 36 months, and we add it into your income. So if it's, if you divide it over 36 and it happens to be $5,000, then we add $5,000 to your income.
I mean, because it is part of your compensation for while you're working at Amazon.
Yeah. What's interesting, I'm refinancing my primary residence, which is it's turning out to be more complicated than I thought, but I'm running into just this issue we're talking about right now. So it shows up on my income and W-2 every year. As soon as it vests, that's like a, compensation. But if you don't spend those, technically you're not using that money. It's on the balance sheet as an asset, but you're not using it as income to pay your bills. So it's like your assets are going up, but your debt to income ratio is not changing. So I just got a request last week from an underwriter saying, we want to see that you're getting the RSUs and that you're cashing the RSUs in to get the actual income. What I'm running into is that I have my primary residence is an Airbnb unit. They don't count the Airbnb revenue because it's not on a year lease. I do traveling nurses, so it's like 30 or 90 to 120 days is usually my typical. But they don't count that as income. So now my debt to income is kind of out of whack. So they're like, well, are you cashing in your RSUs? Because then if you are, then that'll adjust the ratio. So I've got to figure out a way around that to satisfy the underwriting requirement.
Yeah, I mean, that would only be a problem if I don't know the scenario, but if the debt to income is tight, like the ratios, then you have to play with the income to massage it, make the income work. I've never had an underwriter ask me to sell the stocks, so that depends on the lender. Maybe you want to send it to a different lender. So that's one of the advantages I have now that I didn't have before, is that I was captive. I worked at a retail banker, so we only had one option. If the underwriter didn't like it, then we'd had no chance to broker it out. Now that I'm a broker, I already know that, okay, so that lender's not good with RSUs. Don't send it there. They don't like it. They like income that's all consistent. Some lenders are good at that, but they charge you a premium. So it'll be like an eighth of a rate more, but you can have flexibility with all the RSU you want. You can go to Chase Private Bank Group and get, your margin loan that Justin wanted. But as an example, I think they need 500,000 minimum, and they'll lend you up to 50% of your stock portfolio. But every bank is different. If you go to Union Bank Private, it might be different too. So I don't want to veer off too much off topic, but yeah, every lender is different with RSUs. Even within Fannie Mae's guidelines, they add their extra restrictions on, just based on their preference. So,
yeah, and this for me, what the issue is like, to continue to grow, I've done different ways of pulled money, and some of it is I'll take short-term money in my personal name, and then I'll buy properties in the business. Great to acquire the property, but now when it goes to debt to income, that money I borrowed personally is on for me personally for this house. So it kind of it helped me to get the other properties, but then now it's hurting me and trying to get the refinance. The irony of it is that like my monthly payment's going to go down by like $500. So I'm like, if I'm paying the payments now, how's it going to be an issue in the future if it's down 500? But if it's the underwriter wants it, you've got to figure a way to check that box.
They just got to make sure that the loan's sellable. So
right.
They can offload it.
Hey guys, it's Julie here with a quick break from the show to discuss an opportunity some of you may have interest in, which is to work more closely with me. On almost a daily basis, I get calls from investors and brokers, both new and experienced, asking me for guidance or advice. I love helping you guys out, and it keeps me on my toes too. So with that said, I wanted to let you know that I have a private broker coaching community called the VIP Education Community. And the best part is that it's 100% free. That's right, it's free to join. So whether you're a traditional broker or a broker investor, my VIP education community offers personalized one-on-one coaching from not just me, but also from my experienced broker friends with expertise in all disciplines of real estate and real estate investing. We'll teach and share our modern marketing strategies, our tech and lead generation resources, plus teach you how to identify or offer up opportunities for yourself or for your clients using techniques such as seller financing, lease options, land entitlement deals, BRRRR investing, flipping, multifamily or commercial coaching, whatever you like. We've got it all covered for you. The future of real estate is changing fast, and to stay in the game, it's time to learn about all the options you can offer your buyer and seller clients, as well as, if you want, learn how to use those skills to grow your own real estate portfolio. If you'd like more details about joining my VIP education community, reach out to me at julie@seattleinvestorsclub.com or text me at 206-910-2985 or just send me a Facebook message. My new favorite phrase is community equals confidence. So let's navigate the future of real estate together. Now, back to the show. So let's go back, Justin, to your first property that you ever purchased. You sold, is that you sold some RSUs and you just took the cash and you used that as your down payment to purchase it? What type of loan or situation was that at that time?
Yeah, my first non-house hack, so like the second property I got was that 11 unit in Yakima. And that one was a commercial mortgage. And I was trying to buy more in the Seattle area, but I was like, I don't have enough money. And then where's it going to cash flow? And then my brother lives in Yakima. I'm like, I'll check it out there. First weekend, I'm looking on LoopNet. I find this 11 unit property out there. And this goes to show you I don't know what I didn't know. Like, I was like, oh, okay, this is the property I want. I'm going to put an offer. And then I went to a mortgage broker and they're like, wait, how many units is this? And I'm like, it's 11. They're like, well, I can't give you a loan because I don't do commercial loans. And I'm like, well, what's a commercial loan? And they're like, well, anything that's 5 units or more. And I'm like, oh, well, then who do you recommend for a commercial loan? And so then that's how I ended up connecting with US Bank. I can't remember if it was like a referral or if it was just a local meetup. But once I got connected with them, I'm like, okay, let's do this commercial loan. At the time, I didn't even know about LLCs or anything. So I was just doing these commercial loans in my personal name. I was like, let's just get this thing rolling. I don't want to get like hung up. And so the first property, I ended up selling all the RSUs I got and then put them into the property. And then we're getting close to the close. And then they're like, well, where's your reserves? I'm like, what do you mean reserves? And they're like, you've got to have like 3 to 6 months of reserves. I'm like, well, I just used all my money for the down payment. And I'm like, well, you've got to figure, we need to see an account that has reserves in it. And I was like, all right, I hear what you're saying. So then I was able to show them an account that had reserves in it, and then was able to check that box and get the deal closed. But almost didn't. That first deal almost didn't happen because of,
what was your required down? Was it like 25% or?
Generally speaking, on these commercial loans are like 20% down. It depends on the lender. It's 20 to 25. Usually it's a 5-year fixed, 25-year amortization. And some banks will do like a they kind of marry it up where they'll do lower down if they do lower amortization. So like a 20% down will be 20-year am, or 25% down will get you a 25-year amortization.
Gotcha. And do you still own that property today?
No, I ended up selling it. I owned it for 14 months and then I 1031'd that property. But basically what happened was like, I started buying out of state. I'm like, Jesus, this is like way cheaper. And the cash on cash is way better. I've got equity trapped in Yakima. Like I wouldn't buy that property if it was on the market today. And so then I ended up like, I'm just going to repurpose this money into other properties. So I sold it and I bought 5 duplexes and a triplex with the same amount of money.
And so when you switch to buying out of state, like some people might think, oh, you get these cheap properties out of state, but it's, maybe they're in war zones, or the perception is, they're harder to manage maybe, and things like that. Were you going for at that time, you had a day job, you're getting all these RSUs. I imagine that you were getting your lifestyle paid for by your job and, your RSUs, which is part of your job. And so you didn't necessarily need to have cash flow to pay your bills, you know what I mean? Or I guess the goal in that moment, I mean, you still work at Amazon and you've got 62 doors. Why do you still work at Amazon having 62 doors? Is it because the equation of the RSUs dropping into your account is, I personally think people should not quit their day job, and they, unless they hate it, that they should understand that allows them to borrow money, and maybe once you're reached your certain level of your portfolio, maybe so, but why haven't you quit your day job? And why did you go for the cash flow properties when you already had cash flow?
Right. So a couple of questions in there. The first one is, why haven't I quit yet? So at the end of the day, like it's still not enough to replace the Amazon income. And like I always say, this is on a movie or something, but it's like when you're gone, be gone and stay gone. So like I don't ever want to have to come back. So like when I leave, it's like I know 100% sure that I can get out. And I've only had these properties really in 2017 is when I really started. So in the last 3 years, bought the 27 of the 28. A lot of it, like you don't make money for 12 to 18 months. You got to kind of get rid of the old tenants, get the new tenants in. There's turnover. So you're losing rents there. You're putting money in to fix them up, to get new clientele. Some of that deferred maintenance ends up hitting you. That didn't hit me until I actually did my taxes for 2018. I was like, which properties did I make money on? And I looked at it and I was like, I made zero. I lost money on everything I bought in 2018, and I made money on everything that I bought in 2016, 2017. I'm like, oh, okay. So
that's a big lesson for people right there.
Yeah, right? Very simple.
To be cautious and realize that this reserves is no joke. That you really do need these reserves to get started, right?
Right. I mean, my safety net is like I get paid at Amazon fairly well, but I'm in my Airbnb unit, and this is like 3-bed, 1.5 bath. I still live in a 1-bedroom, 1-bathroom. So like my net like monthly cost structure is fairly low because I'm just dumping all of it into the properties. And so the more that I can save, the more that I can buy, which generates more cash flow. But what I've noticed recently, back to the why haven't you quit? One is there's not enough there, but two, I've kind of adjusted my strategy. The strategy has changed to where like I focused on everything for cash flow. And I know we're all in the same network. We see a lot of these other people that are really hitting home run deals here. And really the home run deals have been all, a lot of it is just because the appreciation. One is forced appreciation, but two, just holding in something in Seattle and letting them appreciate. So some recent properties I've been buying are not necessarily cash flowing. I'm trying to balance out my portfolio. I have cash flow in the Midwest, and then I use that cash flow in the Washington, Seattle area to offset some of my more appreciation plays. So I'm actually, my the last couple of properties are lowering my net cash flow because I'm trying to get some upside with appreciation.
So your Seattle properties, you might be in the minus cash flow a little bit, and you're offsetting that with your, Midwest properties or whatever, because you're going for that appreciation play.
Exactly. Yeah, I call it the milkshake model. So like if you've seen the movie There Will Be Blood, there's that famous scene where the guy like talks about the milkshake, and he pulls the oil from his neighbor's yard by drilling underneath it and sucking the oil out. Conceptually, that's what I'm doing. Like I just throw my money in the Midwest, let the cash flow build up, and then I pull that back to Washington, and I use that to buy these. Ideally, it's like a neutral play, but the one I most recently bought actually says about $750 a month I'm going to lose. But in the long game, like if the appreciation holds true, that's going to help me build up the equity.
Awesome. What do you think, Albert?
In terms of the cash flow?
Well, so when you're buying the properties though, Justin, what type of loans are you putting on there in the beginning? That was a commercial property. Are you always putting on conventional financing from the get-go?
For the most part, I'm commercial on everything.
Okay.
At the beginning, I was doing some conventional, but I just actually refinanced out of that. The only conventional one I have is actually my primary residence.
So what's the biggest challenge you have these days with your financing, if any? Or have you figured it out? Did you have like an aha, like, oh, I should do it this way instead of that way? Or, oh, now I'm having different problems because I've reached a certain point. What's your biggest challenge with financing today? And we'll see if Albert can figure it out.
Right now it's there's the flip side of 28 properties in 3 states is that it's like a death by 1,000 cuts. So like to get loans, like it's a heavy lift on providing all the documentation. Like sometimes a lender will be like, I want to see all the leases. I'm like, Jesus. So then I've got to go to every property manager, get all the leases and supply that stuff. So it's cumbersome to continue to get new loans. And with the pandemic going on, certain banks have tightened up. So I've shifted to local banks out of state to help continue to grow. Most recently, like I refied a bunch of properties with a local credit union. It took me like 20 phone calls to find a bank that would lend to me because I'm an out of state person. So really like the hardest part of getting money is like proving that I should get more money. Granted, I was, I was highly levered. And so that's why it's been harder to get lending with other banks. And so to continue to grow, you've got to find alternative options. So I've bought properties in my retirement account. I've done seller financing. I'm finding new banks. I've done partnerships. All these different things help adjust the way the banks look at you.
Mm-hmm. I always say that investors, I feel, are learning the world of investing backwards, that they're learning how to flip a house or maybe about a burr or something like that in the beginning, or wholesaling or whatever, where my personal opinion is the very first thing that they should learn about is understanding debt, how it works, what the rules are, how to use it to your advantage, where you fit in as a borrower. With almost like going to Albert, like he's the doctor, right? Dr. Albert here. So you go and you get started, like when you're born in your real estate investing career, you're going to go to the doctor. Well, our doctor is Dr. Albert here. And Dr. Albert is going to tell us where we fit in our world as a borrower. What lane are we currently in? And then Albert is going to give us the prescription, right? And the roadmap on like a health plan as a borrower on how to change lanes and be a stronger borrower. And I think that the very first person anybody should ever check in with is not a contractor or a wholesaler. It's go get your assessment from Dr. Albert, right? Go get your assessment, because you're going to need to borrow permanent financing at some point, whether you flip and screw up, or you flip for a while and realize, oh my God, I shouldn't have sold those properties. I should have kept them, which eventually people realize. Even the biggest flippers that we know realize that they should have been keeping a lot of those properties, right? And so I, part of my 2021 goal is to get people started on the right path. There's such information overload. What an advantage that you would have from the beginning if you went to Dr. Albert here and you understood, oh, you have a day job and you have RSUs. Let me teach you how to use those. You can use those, sell them for down payment. You can use them as your liquidity proof. You can, use them to qualify for higher income, right? And then Albert's going to know a CPA that can be introduced to you as well to help you, get your package right from the beginning, so you can learn how to shift into faster and faster lanes or bigger and bigger lanes with your, borrowing capacity. Wouldn't you say, Albert?
Yeah, because how you file your returns, it affects how the incomes are viewed, whether commercial or residential. And it is a bit different, but in general, they're mostly the same, how they calculate income. They just look at different metrics. With commercial, they're generally looking at debt coverage, and they are looking at reserves too, but they classify reserves usually as a percentage of the loan. They might do 6 months, but generally they'll say 10% of the loan amount. On conventional, we do payments, or a percentage of outstanding balance too. So if you have 1 million outstanding loans, we'll use 2 or 4, 6% of that balance outstanding as the minimum reserves. But back to what you were saying, Julie, yeah, you want to make sure you know how each deal is going to affect your picture. That way, when you do the deal, the flip, the BRRRR, the whatever, the Airbnb, how are you going to file it? What are you going to show so that when you go to get loans, it's going to be a smooth execution? You're not going to have to rack your brain and provide 18 mortgage statements and insurance deck pages and, schedule whatever on your tax return, right, Justin?
Exactly. I think what you're hitting on there is like two things. If I could go back and start it all over again, these two things are almost kind of hand in hand. Is like having like a binder in the, nowadays virtual binder of like everything that you do. So like all your properties, what entity owns them, what are your expense ratios, how much the mortgage payments are, who's the lender on them, having all that kind of portfolio of what you're at, of what assets you own, what your debts are, what your incomes are, that's huge. And in order to have that, you also need your bookkeeping or accounting. I went I went way too long on really truing up and doing a good job on my books. And so really I'm right now trying to true up all my books and just get a better understanding of where I'm at.
Which is the perfect time to check in with somebody like Dr. Albert here, because before you true him up the wrong way, he's going to be able to give you tips on how to true it up to be to your advantage, right, Albert? I mean, he said, your lending and your accounting, your tax stuff kind of work together, and everybody should be going to like Dr. Albert at least once a year, in talking to him about, okay, Albert, this is what my portfolio looks like right now, or even every 6 months if you're buying several properties a year, right? Or maybe even quarterly, right? Buy him lunch quarterly, and say, this is what I have in front of me that my goals are to buy a couple more properties this year. This is what my current portfolio looks like and my income looks like. And somebody like Albert then is going to give you advice on a regular basis of how to steer the ship to put you in the perfect position to protect your borrowing power. Albert, what kind of stuff do you see from borrowers coming to you that, that they could have done correctly, that they kind of didn't know what they didn't know, as far as maximizing their income or positioning themselves on paper For me, what's always been used is what we call the schedule of real estate, and it gets updated quarterly. And literally, it's just a list of every property. Just like you said, Justin, it's a spreadsheet that covers, what the current market value is, what the current debt is, what the current cash flow is, who owns it, who are the partners, and so forth. In regards to keeping that up, because the equity you have in the property over time changes as well, right?
Yeah.
And so you have to kind of keep up with that, not just in a file where you have all the documents, but where you can change the values around, because you're going to update what your current principal balances are as part of that process, right? And once you are borrowing enough, you're going to need to do that quarterly probably. And so, Albert, what are the top things, like somebody like Justin, or somebody, because we're talking about the RSUs today, for people who haven't used theirs yet or just understanding the power of those from a tax and borrowing standpoint. If somebody came to you and say, hey, Albert, I work at Amazon or Microsoft or Google or whatever, and I want to start buying properties, what would you look at as a lender? What would be?
I would look at how fast they vest, because the quicker they vest.
The pecking order, like what's Albert's checklist? Yeah. Hi, Albert, I'm Julie, or I'm Justin. I work at Amazon. I want to start buying properties. Mm-hmm. Let's sit down. What's your checklist?
Well, first of all, I look how fast they vest, because as soon as they vest, we can use them as reserves. So then I see, okay, do we have enough reserves? And then I ask them where they're going to get their down payment from. Are they going to sell the stocks?
Can I borrow against you, Albert? Are you looking at reserves first? Because no matter if they have the income, if they don't have the reserves, they can't cross the threshold.
Well, generally, cash to close actually is the most important. I mean, if you don't have cash to close, then it is what it is, right? You can't buy it. So cash to close, but generally income first, then cash to close, then reserves. And because income is the most important, it's hard to change. Unless you're on the cusp of filing your tax return, then you could technically change it as soon as you file. But
let's just say if people come to you, you can give them some tips as well on how to make sure that their income is showing at the highest. Everybody as an investor is always like, let me write all that stuff off. Let me write off everything and have no income showing. Well, that's almost like, to me, like people who, it's like a challenge, right? Like a wine collector. Let me see how much wine I can collect. And they don't realize they're shooting themselves in the foot by not going to Dr. Albert to find. That's why you got to be like, well, let me tell you what my plans are for this year, for the next 6 months. And then every year before you do your taxes, you need to sit down with Dr. Albert or your favorite mortgage broker, and you need to plan what your income needs to be at in order to get you to the point where you can borrow money, not just write everything off and get your income as low as possible. Or you want to be an investor, you think you're smart, you just shot yourself in the foot.
I think most people tally it up. I mean, most people, as in most lenders, they tally up the debt to income the minute you submit it. But to be a good investor, you have to understand what the DTI or debt to income is on day 1, day 30, day 120. You got to know what it is during those days. The reason is because what happens if crap goes wrong, or maybe you get it leased up really early and you want to refinance out of that hard money. So day 1, when you're using hard money, let's say it's minus $3,000 a month, your debt to income is in shambles. So you're rushing to get it fixed and leased up as fast as possible so you can change those numbers. So let's say you get it leased for $2,000 and then your mortgage is $1,500, let's say, just simple numbers. You're at positive 500. The second you're at positive 500, you might want to refinance, so you can get that better change, not only for your financials, so you can keep qualifying, but personally too, right? You don't want to lose money every month.
You just gave me a great idea. So I would say it here, the great idea. So on the multifamily properties that I've owned, we've always had like an actual and a forecast annual budget, right? So you take your annual budget, and I always plug my checkbook into the bottom of it so I can real time see the amount of cash balance in my actual account that's tied to the monthly movement of the cash flow on the properties. Okay. So you have your annual budget you start with, and every month you plug in the actual numbers of the performance of the property and you reforecast out. Like maybe something happened, you need to move one of your capital expenditures or some decision you were making, you need to move it out a few months. You have your cash flow forecast, your couple months that are actuals, reforecast the year. It's tied to your checkbook. You can literally see when you're going to have cash flow, where you can predict what's going to be in your checkbook at the end of the year. It's very helpful in making decision making during the year to plug in your actuals and a forecast and use that budget that way. You're looking at that every single month. You're plugging in your actuals and looking at your future forecasts so you can make good decisions. You just gave me this idea, the same thing. Oh, my God, I just came up with a great idea, guys, with your debt to income. So at the beginning of the year, you have your debt to income budget for yourself, I'll say, right? Where you plug in your job income, you plug in your property cash flow, right? And then every month you plug in the actual that actually happened with your forecast of your debt to income ratio. And what that'll allow you to do as things move around and bounce around with your debt to income ratio is actually see, okay, 2 months from now, I need to refinance because I can see forecasted, because I can kind of forecast out what my cash flow is going to be now. And boom, I need to start talking to Albert right now, 30 or 60 days out. So I know when I hit this debt to income ratio on my budget for the year of my debt to income, cash flow, plugging in the actuals, forecasting it out. I know 3 months from now, I'm going to be looking good. Let me get teed up, get all my paperwork in to Albert or my mortgage broker, and boom. So all I have to do once I hit that threshold of, meeting whatever the lender needs, I'm planning ahead of time, and if you do it every month, it really is not a lot of work.
Right. I would recommend that too.
Yeah, I think what you're hitting on there is like two things. Like that's very proactive, and like the more people that you interact with, a lot of these people don't make money unless they do transactions, right? So if you come to them, you know what your DTI is, and you know what the DSCR is of the property. Like a lot of people are going to want to work with you. It's fairly easy for them. Most people, like what I did, is I just come in here. I'm like, yeah, I think I can buy this property. I have enough cash. But I'm not looking at the macro thing. Like it looks like it's going to generate enough profit. I didn't even know about like debt service coverage ratio until like a few properties in. Now I actually look and see like, is it going to be 1.2, 1.25, or a lot of times it's in the 1.4 in the Midwest. But the more that you're prepared up front, the more agents, the more brokers, property managers, and other lenders are all going to want to work with you because like they know that they're not going to waste you're not going to waste their time. And so that's how you kind of reciprocate this. They want to help you. The fact that you're able to be helped makes it, kind of a symbiotic relationship there.
And hey, Albert, don't you, when you're actually underwriting your own deals for yourself, don't you, I think you said it one time that you look at it from a straight up, almost like a debt service coverage calculation. You're actually looking at the deal, whether you should move forward or consider spending any time on it based on kind of a debt service coverage calculation, because you're going to be putting a loan on it, once it's stabilized, right? Tell us how you think about that for yourself, Albert.
I look at the debt to income just to make sure I have room for future properties. And for me, I know every $450 is about 100,000 buying power. So in general, not always, but so I know if I have like $4,000 of room, I could probably fit $1 million of mortgages in there, or maybe 800 or 900. So I don't do exact calculations. I just need to know roughly what I could fit. And that's the loan amount, so that means after down payment and everything. So I kind of figure out that's the potential.
Is that $450 cash flow per property?
Well, the mortgage is 400, taxes and insurance are about 50. So roughly it's 450. It depends if it's a primary or investment, right? Because investment has a higher rate, so you have to use a different number for investment properties. So, but when I'm telling a homeowner, hey, what's your buying power? I see 450 is roughly what it costs for every 100,000. So if I see they have $1 million or maybe 5,000, let's say, of income available to borrow with, then I know they're probably eligible to buy Mercer Island or something, because 1.1 million let's say they have 400,000 down payment, so I know they can buy 1.5. I just add the two together. It's not super tough. And then I have to make up backup plans because underwriters are notorious for coming back conservatively. So you always have to have multiple backup plans, especially if you're working with realtors or agents. You don't want to waste their time. So I always have backup plans just to make sure I can close on it, and try to anticipate what the underwriter will come back with, so you can counter it before it even comes. Is what I generally do. But in terms of buying power on our topic, cash flow wise, yeah, I look at both commercial and conventional because I use a lot of commercial too. So I'm always looking at debt coverage as well.
Awesome stuff, right? So we're just basically telling you guys all today to understand your borrowing power, check in to understand what you can even buy, learn how to use your RSUs, right? So Albert, you said your pecking order of somebody, Amazon, Justin comes to you from day one, he's never invested, or maybe he has. You're going to look at his income. You're going to look at his cash to close. You're going to look at his reserves. What are you going to look at?
Right. Well, the total potential, right? Because I'll look at the total cash available and what he's projected. Because he might tell me, hey, in 6 months, I'm getting this huge vesting or this big, tranche of RSUs are coming at the end of the year is when they release the big one. And there's small disbursements in every Q1, 2, and 3, let's say. But Q4 is the big one. So then we plan, okay, you're going to get that. When is your third year going to be? So we can use RSU as income. Even if we don't need the income right now, I'm still looking at it. How do we use it? When can we use it? And how does that fit in his picture? And what does that mean? Does that mean a bunch of fourplexes in Milwaukee? Or is that going to be a bigger primary? Maybe he buys a big primary and Airbnbs the rest of it and lives in the ADU, which some investors do. That happens a lot, So we plan for that, figure out how to get that type of capability first. So we look at everything: credit, the income, the total down payment, and what's to come as well. Or maybe he tells me, hey, I have 2 rentals that are on hard money right now, but I'm going to lease them up soon. How do they affect me right now? I'm like, okay, so your debt to income is really bad right now because there's 2 hard money loans, right? But when you rent them up, here's how it's going to look. So we're going to try to sprint to that finish line, so we can be in the position where every bank's going to love us when we come in the front door.
How long does somebody need to be at the finish line after coming out of being
right away?
Conventional,
right away. So the second you have the lease and the security deposit. I would say it's the same with most credit unions and local community banks too. They just asked me personally on my loans, the lease agreements. As soon as I had them, I could use it for the debt to income debt service calculation. And most credit unions didn't even ask me for reserves. It's generally the banks like US Bank or the mid-tier regional banks and larger banks and Fannie Mae.
What's the trade-off? Higher rate, or what's the trade-off of going
I would say smaller is more flexible. Like you can do blanket loans, like one loan for like 5 properties, and you can do all sorts of things. You can put it in your trust.
Is there a trade-off? Because you're saying that credit unions are not requiring the reserves sometimes. That's
an advantage. The rates are higher.
Yeah, the rates are higher.
Probably about 1% higher. But for that premium.
I mean, if you don't have the reserves, you just underwrite, buy your bill correctly, right?
And that's why I'm not a commercial mortgage broker, but I use commercial money. And that's why it's important, because in commercial world, every lender, bank, investor, credit union, insurance company, Fannie, Freddie, they're all different. They're like 100 guidelines. So it's not like residential 1 to 4 where everyone does conventional, pretty much 95% of the same. There are little tweaks, like how we look at your RSUs, kind of like what Justin mentioned. Some underwriters are making him sell the RSUs. He might not want to sell because he knows when the Q4 numbers are released, that stock might climb. So why sell right now when you want to borrow against it when it's going to shoot up, right, Justin?
No comment on that last part.
Yeah. We don't know, right? Yeah, we can't tell. No insider trading.
Yeah. But I just know that everybody uses it, so I think it'll be good in the long term.
Yeah.
So Albert, what's the challenge that you see that you run into with borrowers? Either things is there like a common denominator they just don't know, or roadblocks that you run into where you got to send them back and kind of let them get things fixed up for a minute and then come back to you?
Well, yeah, sometimes you meet up with them and there's an income problem right away, or maybe they're in the middle of a couple of burrs and their cards are all maxed out, because they did all these rehabs. So then okay, you got to pay all these cards down so you can get your credit from 680 back to 780. But when you pay off cards, it takes 20 to 30 days to organically update. We can do something called a rapid rescore, which updates it instantly in probably 4 to 5 business days, but it costs a lot of money, $500 to $1,000. Depending on how many cards you have, it could be even more. So there's timing is really important in lending. You want to submit it at different times. Like if he's, let's say a borrower is done with their burrs and they paid up all their credit cards and their credit's updated, now is a good time to pull credit. You don't want to pull it in the middle because there's no point unless you want to do a soft pull just to figure out what the credit is now. It doesn't hit their credit report. So that's what I would do. I would wait for the timing. I would listen to the story first, figure out what they're doing right now, this minute, this moment, and figure out what deals they're in the middle of. Unless they're a brand new investor and they have no deals, that's different, right? That's a blank slate. It's easy to figure out. But some people are complicated. They got a lot of deals going on. Yeah, I don't know. Justin probably has multiple deals, right? You're rehabbing right now.
Right, exactly. What's helped me out is I'm trying not to slow down. So I have seller finance deals I'm working on, which doesn't necessarily play into the economics here, but I do need like a new business credit card for one of my businesses. But then I'm like, well, I don't want to, take on more debt until I get this primary residence locked up, the refinance. So I'm kind of in this holding phase to where until those underwriters checks the box and I'm able to close on this deal, I'm not able to do what I want to do on everything. So
it seems like, Justin, you have all the parts necessary to succeed, right? You got a W-2, you got the RSUs, you got some cash flow, you got some time under your belt to know what you're doing. And so 2 questions, what's your advice to people or the challenges on buying through an entity versus, like you said, just going for it in your personal name? Do you have any recommendations or hindsight or future information on that topic?
Yeah, I'm actually in process of that right now. So I'm moving to a series LLC setup and to kind of avoid any sort of potential pitfalls, i.e. litigations. The more properties you get, the higher probability of getting
So you're
sued.
moving to series LLC for asset protection reasons.
Exactly. In terms of starting out though, I see this all the time with these local meetups, is that a lot of people will get hung up on it. For me, these first couple deals are fairly small. So what's $15,000, $20,000? Just get it done and you can, adjust, course correct from there. So I wasn't really hung up on it. I don't.
Well, it's not, that's the cash required to purchase it, but you have a loan behind it that you're responsible for. And I think that the scarier part is some sort of issue with the loan in regards to not just your cash that you're going to lose, but, having some sort of problem with the loan on your record. As far as personal versus entity.
Right. Yeah. And I was running into that recently with my current refinance because I had a couple of the properties in Milwaukee that I had actually taken loans out personally versus in my entity. I have since refinanced those, which have helped kind of remove that underwriter contingency. So there is a pitfall. If you put everything in your personal name, you got to show the income in your personal name as well. Otherwise, you're going to jack up the DTI, which is what I ended up doing. So now I'm trying to, as I'm refinancing into the new entity structure to keep me personally separate from all the businesses so that I can keep my DTI in a good position.
So you're moving your personal entity, your personal properties in your personal name into an LLC or series LLC or something like that?
Any loans that I have in my personal name, I'm aggressively either refinancing them or just paying them off. So like for 21, there's a couple like I've taking up. I had a personal loan under, and then I use that money to put into my business to buy properties. But that's still hanging around my neck personally, which is my refi is getting hung up on it. So I'm going to focus on using that money that's in the whole life insurance policy, take that, pay down what's in my personal name, so that at the end of at the end of 2021, like I only want this property in my personal name to be for my DTI. Everything else needs to be within the business entities.
That's a whole nother podcast topic, the infinite banking using the insurance. We'll save that one for another day, because don't even get me started. I'll go down that rabbit hole. Super awesome. So, and so now you've discovered, or how, seller financing deals are starting to, tell us about your purchases using seller financing or creative deal structuring, which is my number one favorite topic, aside from this debt education, debt planning with Dr. Albert here, which I want to put in everybody's face for 2021 to start starting with that, right? And moving forward from there. My other favorite topic for 2021 is structured deals, which is, seller financing in layman's terms, I guess I'll say. And tell us what your recent success or anything deals that you've done in that way, and how they're structured, and how you made it happen. And what that's done for you. Has that taken a burden off you in regards to this borrower stuff?
Exactly. So I've done 4 seller finance deals, and then I got working on a 5th one. Hopefully I close it up this week. But the first one I did was, or I go back to what's the benefits of it? It is anything that you negotiate with the seller goes, because like it's only you and them. So you can you can inflate the price if you need to. You can do lower down payment. You can do 0% interest. You can adjust the parameters such that they work for both parties. And so, like my first deal that I did was probably actually the most complicated one, and it was actually off of Craigslist. Christmas 2 years ago, Christmas night at like 10 o'clock, I was just laying in bed trying to I was looking at real estate, and so I found this property.
You and Carl were laying in bed.
You're right. And so I was like, let's see if we can't find a deal here, because a lot of times I find deals during the holidays. Most of my bigger deals have been during holiday periods. So I ended up finding this deal. I connected with the seller, and I had listened to or just through the course of the years, like listened to other podcasts about seller financing, and then Brandon Turner's book on rental properties, and his other one I was like low and no money down. And so I started conversing with this seller. I was able to build rapport because she was using Equity Trust Company. I was using Equity Trust Company for self-directed IRA. I've since moved away from them, but I knew about that process. We were able to connect there. So she's like, okay, you sound like you know what you're doing. And then as I started understanding what she was looking for, I gave her 3 different offers. I gave her the cash now. I gave her a slightly higher priced offer with interest. And then I gave a higher priced option, no interest, so principal only. She ended up taking the middle option, which is the best for me at that time in terms of a cash on cash return. And so I was able to get the price that she wanted, the low down for me. So I think I bought it for, I think it was around 90,000. So normally at a bank you would need 18 to 25,000. On this one, I only had to bring 10% down. So right there, I'm able to save cash, but I'm still able to acquire properties. These properties don't like show up. I don't know, Albert might know the answer, but these don't show up on any like polls in terms of debt load. Now you're supposed to put them on your real estate list, which I do. But as you're acquiring them, if somebody pulls a credit, they're not going to see those on there. But I was able to set it up. And what did we do? I think I did like 30-year fixed, I think 6% interest. So like 6% even 2 years ago, kind of on the high side, but it's what got the deal done. I'm using the cash flow from the property to pay that 6%. I'll still get my target cash on cash percent. with the overall deal structure. I have since refinanced out of that, and now I'm at 3.5% on that.
Awesome.
Nice.
Good stuff. So that's, yeah, I mean, everybody needs to understand. I mean, if you want to get ahead in real estate, definitely learning seller financing should be, aside from learning and understanding debt, I'd say the number 2 thing. I think learning how to buy a property and manage a property and renovate a property is lower down on the list than understanding the debt and creative real estate structures that might allow you to get ahead faster. So all good stuff. Has COVID affected any of your properties? Just curious.
Yeah, definitely in the Midwest, I'm seeing lower or slow paying, and it kind of goes in waves. So what ends up happening is like, I'll have 70 to 80% collections, and then they can apply for like local grants, and then I'll get like 3 months worth of rent. So it's kind of very like sporadic in terms of getting cash in. And then I used to have just regular Airbnb in this unit that I'm in right now, but it basically dried up overnight, and the bookings I had, they canceled. So I didn't have anything for March and April, I believe. And then I heard about traveling nurses, and I'm like, I'll try this out. Obviously a lot of nurses are coming to Seattle.
Right.
So now I'm on my 3rd set of nurses. They're coming in January, which has helped out. The other thing, if you guys are familiar with the CARES Act, you have the opportunity to pull money out of your retirement through a certain time frame. I think the time frame's already passed, but when this thing first hit, I was like, oh my God, I'm going to be like, nobody's going to pay me. So like, I cashed in my retirement, not all of it, but a good portion of it, up to, I think you could pull up 100,000. So I already had a loan against my retirement. So I paid off the loan, and then I held the rest of that cash just in case people either didn't pay or slow paid. So, in reality, like, I don't know what the actual number is. So like when I get my bookkeeping updated, I'll have like the actual numbers, but in my opinion, it hasn't even gotten bad yet. So hence, while like in 2021, I want to continue to grow, but on the flip side, I want to start stacking some cash up because it hasn't got bad yet.
Right. So, cash is king, they always used to say, for purchasing and everything, but cash is king, more importantly, probably these days, for your reserves, right?
Exactly.
And, who knows what's going to happen. But all right, guys, we've gone long here today. I could talk to you forever, Justin. Maybe we'll have to have you back on and talk about this infinite banking topic. That'd be fun. So I'm just going to wrap it up here. And Dr. Albert, as I'll call you, that's my new name for you, for you guys that are thinking about getting started or feel like, okay, got 1 or 2 under your belt. My high recommendation to you, I think everybody here, and Justin will agree, is to go check in with a lender. Go get your temperature taken by your, somebody that is your mortgage broker, and, get your plan in place with forecasting what your cash flow looks like, forecasting what your debt service, your debt to income ratio looks like, so you can plan and be more informed. Because when you do that, you actually end up, opportunities will arise that you didn't realize, because Albert will say something to you that you didn't realize, for example, or give you a tax tip that'll set you up for a success as you move forward. And you can't do that soon enough. So we'll let you guys know how you can reach Albert when this is over here. But
Awesome.
So last thing, Justin, I think you said you got a lot of your education off podcasts, and I think you even said YouTube. Who are your favorite go-tos? I know we all love and cherish Bigger Pockets. That has been, very important for all of us. Is there any, besides Bigger Pockets, is there anywhere else that you listen and get your information from as you continue to grow?
I listened to your guys' Seattle Investor Club last week. That Kevin Kalinske guy. Oh my gosh, that guy blew my mind.
We're just getting started with Kevin.
Oh man,
What?
I need to become best friends with that guy. He's like he went to the 3rd degree on that example. I'm like, oh my god, that's amazing.
Yeah,
Never would have thought of
what?
that.
I have paperwork from him that anybody who listened to the end is going to get a copy of. So you be on that list.
Nice.
And I believe that I've got Kevin, encouraged to show up on our Thursday weekly roundtables that we're doing. So if you ever have a deal, anybody out there, and you're like, man, I could use some creative financing tips or structured deal tips. Kevin, I think, will be joining us from time to time, or give me a heads up and I'll nudge him to join us because he loves paying it forward. That's how he pays back, the legends that he has learned from. And we are blessed. Thank you again, Troy Fisher, boom, 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 for hooking us up with Kevin. Couldn't be. Thanks for mentioning that, Justin. So go back, guys. And so you listen to ours. I appreciate that. Thank you very much.
Yep. And then, Tarl's done a great job keeping, at least once a month, they'll do Fix It on Real Estate. They'll have a panel of industry experts. So I like those ones. Lately, I've been putting a lot more focus into YouTube and more centered around macroeconomics versus specifically real estate.
Have you heard of Meet Kevin?
Yeah, Meet Kevin. That guy is just killing it.
Right?
Yeah.
I'm going to try and get him on. I'll tell you what.
He's pretty amazing. Like supposedly he makes like $6 million a year off of that channel.
Oh, it's crazy.
But, he's pretty cool. And then Ken Mcelroy, I watched his YouTube. He's really started putting out a lot of content lately, so that's good. There's another guy in terms of macro. I listen to like George Gammon.
George Gammon.
Yeah. Revel Capitalist Show. I'm drawing a blank on the other ones, but there's a guy in Florida that's been doing a long-term podcast. I'm drawing a blank on his name, but he's been really good to listen to. If I remember, I'll shoot you an email with it. And put it in the notes. But a lot of YouTube, a lot of podcasts. Another one I just started getting into, I think it's called Just Start. And I think his name's Mike Simmons. I think he's based out of the Detroit area. But cool. I like the mindset of him. I just like got to get into it, and that's what I tell like a lot of people that come to me and they have questions. Like you see the analysis paralysis all the time. Like within 30 to 90 days, you're gonna have like 80% of what you need to know. The rest of it is all about putting deals out there.
Right.
That's where the true learning happens. But you got to shift from that education to live ammo.
Jennifer Beadle's group, Agents Invest and Addicted to ROI. She's got some great content. She's got a summit coming up here, I think in February, that's going to be really good. And yours truly is on that as a panelist. I'm excited to put the word out about that pretty soon with Jennifer. For all of you guys who are interested in investing out of state, definitely look up. What doesn't matter where you are. It doesn't matter what state you're listening from right now. Agents Invest and Addicted to ROI is the Facebook group you should jump on to not only get deals, but get education, continuing education about investing out of state. So we love Jennifer, we love Tarl and that group. And we actually have Jay Scott coming on as our first drop here in 2021. He'll be our first show that drops. So we've already heard from him actually, because we're going to be dropping this after that. But well, good stuff. And what do you do for fun? That's the last question. You and Carl hanging out like me and Buddy. And most of you guys know my sidekick, Buddy Clark, and is my Labradoodle who goes everywhere with me. Justin's got Carl. Right. And what do you guys do for fun, Justin, outside of working and building your empire?
I'm usually, for me, it's all about sports. I like to do stuff where I don't have to think. So it's usually chasing a ball or a puck. So like I do golf, hockey, soccer. Obviously, in the last 10 months here, I haven't done much of the soccer or much of the hockey. Luckily, there's been golf out there, so I've been doing that. So really, my only exercise has been Peloton. So I've been doing a lot of Peloton and golf.
Nice. How about you, Albert? What do you do outside of work and all
just
that?
Work. No, I'm sure. I snowboard, mainly fitness, running. And good thing snowboarding's coming back right now. So
I didn't know you're a snowboarder. Joe and I are snowboarders. We'll have to have like
I heard him say.
Yeah. I mean, that's all we do right now, pretty much. In fact, I think we're leaving tomorrow to get somewhere in time for the first, to have a day of snowboarding on January 1st. So we'll have to hit the slopes, Albert. That'd
Yes.
be fun. Little SIC snowboarding party, right?
Yes.
Exactly.
I'm always up for it. Let me know.
Absolutely. All right, guys, we're going to wrap it up today. Good stuff, right? Get to know your debt position to set yourself up. Get to know, check in with Dr. Albert or your favorite mortgage broker. If you are somebody that has a W-2 and is lucky enough to have the RSUs, or in general, if you're a W-2, it doesn't matter if you have RSUs or not. We just wanted to make sure everybody today knows how you can use those to your benefit without even selling them. How crazy is that? That also goes for the rest of your stock portfolio, right? I personally diversify myself, and I have a sizable stock portfolio. I don't get RSUs, but I could certainly borrow against my portfolio for investing purposes. So again, whether you have RSUs or you just have a different portfolio, something to check into to elevate your game there. And so for all you guys that want to meet people like Albert and Justin and our new friend Kevin that we're talking about, that we're excited about for 2021, you can join us every single Thursday. I'm just wrapping up the admin details now. From 11:30 to 12:30, we have a roundtable meetup where we're talking about first agenda item on every week is just to solve people's problems. Like, does somebody have something they need help with, a deal they need to put together, or a lending issue, or they can't get a property sold, or whatever it is, doesn't really matter. If it touches real estate, we're there to collective genius. I'm borrowing that term. I don't know if it's trademark, so I apologize. Don't mean to do that. There's a group out there called Collective Genius. You guys can look it up, but that's what we do every Thursday morning. Help each other out. Deals happen. Partnerships are made. Money is borrowed and lent, every week. So you can find the details of how to jump on that on the Zoom link. Just go to meetup.com and look up Seattle Investors Club. And every Thursday morning, just grab that Zoom link. It's free to join us. And I'll remind you guys that for 2020, we've recorded all those meetings. They're all on our YouTube page, which you can just go to YouTube and look up Seattle Investors Club. You can listen to any of the past meetings. Those are good things to do while you're driving around stuck in the car. That's usually what I do. But going forward in 2021, we are still going to be recording those. It is still free if you show up and join the conversation. But those recordings are going to be now in our membership site for Seattle Investors Club starting in 2021. And it just is $220 a year to join Seattle Investors Club. And from time to time, of course, we have specials that we run to get that even lower for you guys. I'll tell you, it's the cheapest education you're going to find, frankly. But other than that, join us on our YouTube page and subscribe so you don't miss all our awesome content. We have some big stuff coming out, and I'll say I'm not going to jump into all the details because we're going so long today, but join us on our Facebook page to find out more of the announcements that we've just made that are cool coming up for 2021. Facebook, that's Seattle Investors Club. Join that. It's free. We'll let you in if you answer a few questions. And other than that, Joe, where can everybody find the details and show notes of today's podcast?
Yeah. All of the show notes and links that we've talked about today can be found at seattleinvestorsclub.com/137. That's seattleinvestorsclub.com/137. And I want to thank you guys for continuing to give us reviews on your favorite listening station or on YouTube with those comments. Keep those coming. We've had them coming in lately, and we really love it. So thanks for that.
Thanks, guys. We love you. All right. All right, guys. Over and out.
All right. Thank you. Have a good day.
Thanks for listening to the Seattle Investors Club podcast. If you have questions that you'd like to have answered on the show, shoot us an email at info@seattleinvestorsclub.com. Now go out, take that action, and build that real estate business. Thanks for listening.